Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from SurgePays, and let's just say their financial moves are about as smooth as a dial-up connection in 2025. You'll see what I mean in a few minutes. In short, SurgePays just took out a big loan, but the terms might make your eyebrows raise higher than the stock price of a meme company. We'll break down what this loan means, what SurgePays had to promise, and whether this is a smart move or a sign of trouble. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come and join us. Alright, let's get into it. SurgePays, a Nevada company, made a deal with Funicular Funds, a financial company, on May 12, 2025. They signed an agreement where SurgePays got a loan of almost $7 million, where this is basically called a senior secured note purchase agreement, but let's just call it a loan deal. The loan is for $6,999,999 senior secured convertible note. Senior means that if SurgePays goes bankrupt, this loan gets paid back before some other debts. Secured means the loan is backed by SurgePays stuff like buildings, equipment, or their money. If they don't pay, the lender can take those things. Convertible means that the lender can turn the loan into SurgePays stock. The loan isn't free. SurgePays has to pay interest at 1.25% per month or 15% per year. That's a pretty high interest rate. The company can choose to pay that interest in cash or by adding it to the loan amount. Here's where it gets interesting. The lender, Funicular Funds, can convert the loan into SurgePays stock at $4 as €8 per share. But if SurgePays issues new stock at a lower price, the conversion price goes down. This is called a down round adjustment. This protects the lender from losing out if SurgePays sells shares cheaply. After everything was said and done, SurgePays ended up with about $5.9 million in cash. Part of the deal was that the lender gave back 333 shares of SurgePays stock, paying $3,000 RES per share. SurgePays has to start paying back $500,000 each month starting January 2026. The rest of the money is due on May 12, 2027. But the lender can turn the loan into stock before then. There are limits to how much of the loan the lender can convert into stock each month. The lender can't convert more than 125,000 shares or 10% of the average daily trading volume of SurgePays stock, whichever is biggest. Also pay stock and paid depending on what they choose. SurgePays can pay back the loan early if they want to under certain terms. If SurgePays messes up, the lender can make them pay back the entire loan right away, plus extra money. If SurgePays goes bankrupt, the entire loan plus extra money becomes due immediately. If something big happens like SurgePays getting sold, the lender can demand to be paid in cash. There are rules about what SurgePays can and can't do while this loan is outstanding. For example, they can't take on too much new debt, pay dividends, split their stock, or sell off their stuff without permission. They also have to meet certain conditions after the deal closes. To make sure they get their money back, the lender has a claim on most of SurgePays' assets. This is a security agreement. If SurgePays doesn't pay, the lender can take their stuff. On top of everything else, SurgePays gave the lender warrants to buy 700,000 shares of their stock at $6 per share. These warrants can be used right away and last for 5 years. SurgePays promised to register the shares from the warrants and the loan conversion, so the lender can sell them easily. The company put out a press release about the loan deal. Now, let's step back and look at the big picture. SurgePays got almost $6 million that could help them grow, invest in new things, or pay off other debts. But the interest rate is high and the lender has a lot of power. They can convert the loan into stock, which could lower the stock price for other investors. If SurgePays can't make the payments, the lender can take their assets. The restrictions on what SurgePays can do could also limit their flexibility. On the other hand, the lender can convert the loan into stock, which would give them a stake in the company's success. This loan could be a good thing or a bad thing for SurgePays. It depends on how they use the money and whether they can meet the terms of the deal. The high interest rate and the lender's power are definitely things to watch out for. Alright, that's our breakdown of SurgePays' loan deal. What's your take on this move and what it signals for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.